Catalyst for us was the management team that came in. So it's 40% owned by a PE firm now. So Oakbridge, great deep value players in the market, great turnaround players. So the guy that's come on he's run 2 businesses in the States and turned them around, both retailers. Looking to do it again, obviously, in Billabong. I think the thing that's most appealing about Billabong is, and I think you might be aware of this as well, starting a business yourself, but you would say if you've got a revenue base, it's much easier to build a big revenue base into profitability. It's much harder to grow revenue and build a brand. Billabong is, until recently was the most well-known sports brand in the world. Now it's number 2 to Nike. It gives you that sort of leverage. It's a $1.2 billion revenue company. This is not a small company. Back in the day, this business used to do 12% NPAT margins. Now it's doing nothing. If you get to 12% NPAT margins on a P of 3, these people that have come in, they've changed the whole management team. Working capital's come down. It's almost debt-free. There's a lot of low-hanging fruit for this business, and if they can get it right, I guarantee you it'll be a $2 or $3 stock, not a 60-cent stock where it is now. The first thing, you've got to really fix the relationship with your customers. So Billabong is still a big wholesaler, especially overseas. So people had a lot of issues when they had the financial issues with Billabong. They're saying, I'm going to give you some money, I might not get any stock back, you might go broke. It's about building that relationship again, building that trust. Concentrating on your brands, make sure that's what the customer wants. And then I think the biggest thing for Billabong is really cutting back that cost base. They've got duplication of cost base everywhere. So whether it's accounting in Australia, US, and Brazil, or Europe, for example, they had accountants everywhere, finance functions everywhere. It's about centralising that cost base, pulling a lot of costs out of the business, and then it's about increasing that gross margin. But I think if you look at, although they're very complex, they are very much doable. It's not saying, I'm going to build a global surf brand from scratch and I'm going to see how I go over 10 years. It's saying, I've got a global surf brand right now and I need to do these 5 points, is what they speak to get to where I need to be. And it's very achievable, but albeit, 3, 4, 5 year view. This is not a 6-month view. Yeah.
Final point on Billabong, as you mentioned, a US PE firm is the largest shareholder.
Yep.
To what extent does that influence, or how do you view that when you go into a stock?
Look, don't have an issue at all. We've spoken to the company an awful lot about it, and they'd happily say it's been a fantastic outcome for them. The amount of resources they've had at their fingertips, consultants, whatever it may be, and not really paying a lot for that has been exceptional. For this PE firm to make money out of it, it's all in the equity value, all the shares that they own. They can't make money out of any other way. So why not be an investor alongside a private equity firm, especially like Oakbridge, which has world-renowned in deep value plays like Billabong. I think it's no different from Eddie Bauer, for example, is another one of theirs. It's no different to something like that. And the way we see it is we don't have an issue like that at all. If you've got different capital structures, then I think that's an issue. But if it's just equity, don't have an issue at all.